All right, today we are going to dive deep into one of the most complex and, honestly, fascinating corners of modern finance, the world of quantitative options trading. We're going to peel back the curtain and really demystify how just a handful of elite, math whiz firms have completely changed the markets you and I trade in every single day. So, this probably looks pretty familiar, right? It's a standard options chain. You've got your strike prices, your calls and puts, and all the usual columns for price, volume, and open interest. For most of us, these are just numbers, data points we use to figure out a strategy. But for a very specific group of people, this isn't just a table, it's a map to a hidden world. And this quote, it just hits the nail on the head. For these quantitative traders, the quants, this simple-looking table is a live, high-stakes battlefield. It's a place where powerful algorithms are literally locked in combat, fighting for tiny, microscopic edges that are measured in microseconds. So what is this invisible battlefield? What's really going on behind the numbers on your screen? Let's pull back the curtain and see who's really pulling the levers in this hidden war and what they're actually trying to achieve. You know, the key players in this war aren't the kind of Wall Street traders you see in movies. No, they're a completely different breed. They're this incredible blend of high finance, advanced mathematics, and seriously cutting-edge computer science. So when we say quants, we're really talking about a handful of powerhouse firms. You've got names like Jane Street, Citadel Securities, Optiver, and SIG. And here's the crucial thing to get. These places operate more like Silicon Valley tech companies than they do old-school hedge funds. They aren't just making bets on which way the market will go. They are building massive, complex systems to basically become the plumbing of the global markets. And the sheer scale of what they do is, well, it's staggering. To give you some perspective, Jane Street alone was estimated to have raked in over $2.3 billion in revenue from the Indian options market. And that's in a single year. This isn't some side hustle for them. This is the main event. Okay, so knowing who they are is one thing. But the billion-dollar question is, how do they actually do it? How do they make all that money? Let's unpack their high-speed playbook, which is built on insane precision and strategies that are just fundamentally different from how almost everyone else sees the market. The absolute bedrock of their entire business is something called market making. Think about it. When you go to buy an option, who do you think you're buying it from? More often than not, it's a quant's algorithm on the other side. They are always there, on both sides of the trade, constantly posting a price to buy, that's the bid, and a price to sell, that's the ask. Their profit is the tiny, tiny difference between those two numbers. Let's walk through a super simple example. An algorithm puts out a quote. It's willing to buy at 650 and sell at 670. A moment later, one trader comes along and sells to them at 650. Almost instantly, another trader buys from them at 670. Boom. They just captured that 20 paisa spread. Now that sounds like nothing, right? Trivial. But multiply that tiny profit by millions and millions of trades every single day, and suddenly you're looking at a massive revenue engine. But to win that spread game, over and over again, speed is absolutely everything. They're in a constant, relentless race to zero latency, which just means zero delay. And the lengths they go to are incredible. They literally put their computer servers in the same building as the stock exchange's computers. They use custom-built hardware, these specialized chips called FPGAs, that can process data faster than any normal computer. And they pay a fortune for private data lines so they don't have to use the slow public internet. I mean, in the time it takes you to blink, their systems have already seen the data and reacted. But look, it's not just about being the fastest. Quants are often playing a totally different game. They're not betting on which direction the market is going to go. Instead, they trade probabilities. And a big part of that is betting on volatility itself. You just have to get two ideas. Implied volatility is what the market thinks is going to happen, the expected chop. Realized volatility is what actually ends up happening. Whenever there's a gap between those two, a quant sees an opportunity. And then there's another super elegant strategy called gamma scalping. Again, this has absolutely nothing to do with predicting where the market's headed. It's all about making money from the little wiggles and jiggles in a stock's price throughout the day. Basically, their algorithms are set up to automatically sell a tiny bit every time the price ticks up and buy a tiny bit every time it ticks down. Each one is a tiny buy low, sell high trade that generates a small profit, and it just adds up and adds up over time. So all that theory is great, but what does this kind of power look like in the real world? Well, let's look at a really fascinating and, yeah, pretty controversial case study that shows you the kind of market-moving force these firms can really bring to the table. So here's the alleged play-by-play of a strategy Indian regulators claimed Jane Street used. They say Jane Street started the day by buying a massive amount of futures, basically forcing the market up. Then, right at the peak, they allegedly sold a bunch of expensive call options and bought a ton of cheap put options. And then came the final move. In the afternoon, they dumped all those futures, sending the market into a nosedive. The result? Those calls they sold expired worthless, and the puts they bought went to the moon. And the alleged profit from this single day of activity? A mind-blowing 734 crore rupees. Now, to be fair, Jane Street's position was that this was just sophisticated arbitrage, profiting from price differences, not manipulation. But whatever you want to call it, the incident is a perfect showcase of the immense power these firms have to shape market dynamics on a truly massive scale. So, we've met the major players, we've looked at their high-speed playbook. And this brings us to probably the most important question of all. Where does this leave you? Where does the average retail trader fit into a market that's dominated by these giants? Let's just be really clear about this. The playing field is not level. The quants have an absolutely enormous edge. Their speed is something we can never match. Their capital base dwarfs any retail account. Their technology is built by teams of PhDs in physics and math, and their risk is managed 24/7 by automated systems that never sleep and never get emotional. You are not playing the same game. But, and this is a really big but, that doesn't mean it's impossible to win. It just means the game has changed. You can't beat the quants by trying to play their game of speed. It's a losing battle. Instead, the edge for us, for individuals, is often in the places where algorithms struggle. Things like longer-term thematic trades, digging into less liquid stocks that quants avoid, or using your own unique insights that a computer just can't model. Yet. So, the next time you pull up an options chain, I hope you remember what's happening just behind those numbers. It's not just a static list of prices. It's a dynamic, invisible war being fought by algorithms at the speed of light. And that really leaves us with one final question to think about. Now that you can see this invisible war,